Welcome to the B.F. Anderson Techno Fundamental Report for April the 18th. First of all, tell me, is there some society you know that doesn't run on greed? You think Russia doesn't run on greed? You think China doesn't run on greed? What is greed? Of course, none of us are greedy. It's only the other fella who's greedy. Milton Friedman, what a great economist. Remember the movie Greed is Good? Gordon Gekko. Jesse Livermore says, if you can't sleep at night because of your stock market position, then you have gone too far. If this is the case, then sell your positions down to the sleeping level. Boy, I can identify with that quote. It is very important that you get a good night's sleep. You know, stocks tend to go up on an escalator, but they tend to go down on an elevator. I just think there's an observation here that, and we're going to talk a little bit about volatility, but trends up and then drops are always difficult. Now, just want to refresh your memory on this book here by William O'Neill. We're going to talk a little bit about William O'Neill, but it's really a good book. And the main point of the book is that you've got to control your losses. You can't allow an investment in a security to deteriorate to a point where it just can't recover. Good example of that was Eastman Kodak. I mean, back in the 70s and 60s, this was, one of the top stocks that you could have invested in. But along comes digital photography, and they go bankrupt. Now, let's talk about taxes for a minute. We just finished April the 15th. It's always an interesting period. And when it comes to investing in the stock market, there's really more than one way to skin the cat. There's really a couple of ways to deal with the Internal Revenue Service, where you've got to, if you have a capital gain, which I really wish they'd get rid of capital gains taxes, but they're not going to. But one way is to buy and hold and get a long-term capital gain. But what if you're in a situation where you've got a gain, but the story is deteriorating? Example would be Tesla. I really am glad I sold Tesla several years ago because it just isn't working out. But anyway, what we refer to here is something called a tax bank. It's a strategy where you take small losses, and I mean small losses. They're not big losses, and you basically use that loss as a loss carry forward, because you can carry losses forward indefinitely. It's a great advantage. Now, the other strategy would be to get as much money into an IRA or retirement plan that you can, because everything within the plan is tax deferred. Always want to defer the taxes. Now, one thing O'Neill says is, and he has a set of rules. He says, worrying way too much about taxes and commissions. The name of the game is to first make a net profit. Excessive worrying about taxes usually leads to unsound investment decisions in the hope of achieving a tax shelter. You can also fritter away a good profit by holding on too long in an attempt to get a long-term capital gain. Some investors convince themselves they can't sell because of taxes, but that's ego trumping judgment. You can't mix investment decisions with tax decisions. You just got to do the best you can. Look, we live in the United States of America. It's the greatest country in the world, and we've got to pay taxes. So on the other side of the fence here, this particular graph shows that between 1980 and 2014, what percent of these categories had their stocks have catastrophic losses? Well, technology, because, risk of obsolescence, like at Eastman Kodak, telecom, so forth. You can see here that in most of the growth areas, including energy even, you're looking at a 40 to a 50% possibility that you may not get that long-term buy and hold situation. Now, O'Neill says here in his book, he says, speculators in the stock market have lost money, but I believe it is a safe statement that the money lost by speculation alone is small compared with the gigantic sums lost by so-called investors who let their investments ride. So what, O'Neill is saying here is that you've got to be an intelligent speculator. and you have to see the danger signals, and you really need to take quick action at some circumstances. Don't worry about the taxes. When a stock starts sliding downward, no one can tell you how far it's going to go. Like Eastman Kodak, another example. There's tons of examples. Nor can anyone guess the ultimate top on a stock in a broad upward movement. A few thoughts should be kept uppermost in mind. So basically, you've got to stay on top of it. So let's take a quick look at the market. Last couple of weeks we've been talking about what I call my early indicators. Now, these indicators here, we use different moving averages, but it's the same basic concept. You want to see the price of the index stay above, at least stay above the lower moving average, which is the 50-day. Here we have the NASDAQ. You can see it is breaking down here. So on an intermediate term basis, we're seeing a downtrend in the NASDAQ. Mid-cap's even worse. They're coming down as well. This is kind of a time, this is a warning. It's telling you that things are starting to top out here a little bit. New York Stock Exchange, same thing. That's all the stocks on the New York Stock Exchange. Now remember, the Dow Jones Industrial Average is only 30 stocks, and they're mainly industrial, cyclical companies. And you really need to look, we're now looking at 6 indexes. We were looking at 5. So let's look at number 4 here. Number 4 is the small caps. Now they are really having a tough time here. If we don't hold that 200-day moving average on the small caps, that's really kind of a risk-off scenario. Here's the S&P 500, same story. So as you can see here, we're seeing all these indexes are starting to somewhat break down a little bit. Now, volatility has picked up. Now, I want to mention the VIX index. We do keep an eye on the VIX. It's been very, very stable here really since the beginning of the year, but all of a sudden we're getting a spike in volatility. And I have to say that, with the elevator and the escalator, that when the market's going down, volatility is much higher than when the market is going up. So we want to watch the VIX. If it gets back above 21, that's kind of a critical area. Now, here's the aggression index where we compare growth stocks to value stocks. Basically, we look at the consumer staples divided by the S&P 500. So it's basically saying, are growth stocks outperforming? Well, you can see here we've been in a very strong uptrend. And really, a couple of months ago, I kept mentioning how we probably would need to do some consolidation in here. And hopefully that's all this is. But we have broken down below that upper moving average. Again, it's just saying you need to kind of, play it kind of cool here. Now, in our 3 economic indicators, here's the culprit. Interest rates have been trending up, which is not good. Then we've got the price of oil. Looks like it's above the 200-day, is in an uptrend, but is somewhat consolidating here around the price of about $85 a barrel for West Texas. Also, we're in earnings season, and the banks have been announcing their earnings. JP Morgan didn't have a real good reaction. Bank of America didn't have a real good reaction, and so you can see these stocks have kind of pulled back. So all in all, I would say it would be a good time to kind of slow down a little bit, really pay attention to what you're doing right now. We're seeing, some early warnings. Hopefully this just kind of doesn't pan out to be anything more serious than a correction, but we are in a correction. So if you have any questions, please let me know.